Hi everyone, I hope you're all doing well, and today we'll talk about 3 cheap UK stocks for you guys to add to your watch list, or some of you guys might be really interested into buying these companies. And I'm talking about these 3 companies being cheap because of the share price being sold off compared to what it had been previously, more than likely pre-COVID as well, guys. So yeah, these are not stocks I own, but maybe some stocks that you guys might like and want to take a look in. If you are going to take a look into them, guys, as always, please read the annual reports, okay? This is just kind of me suggesting things at you guys, so make sure you do your full insight into the company before you do buy, guys. As always, guys, smash the like button. I know you like these sort of series, talking about some UK stocks to look at, and I'll get started on the video. So number 1 is a company that pays a little bit of dividend. It also has a little bit of growth, and it is a compare the insurance company. So one of those where if you need some say insurance for your car, you go on this site, compare from other kind of insurance plays, like which is the cheapest, and then you take that insurance and the company gets a little bit of the money from it. And this company is called Money Supermarket. Like I say, it's a company that I currently don't own, but it's probably actually maybe my favorite on this list that I'm actually going to be doing for you guys today. Around about June 2019, this stock was about £4, and then it's dropped all the way down to £2.80. Not as much as a big drop from COVID as the other companies. In fact, it actually started to recover from the COVID lows, all the way up to £3.45, and then it started dropping back down. The ticker symbol for this one is MONY. And the company trades at about a 17 PE ratio, which is still okay, compared to like the industry market. Pretty fair valuation, really. And it does have a lot of good things going for it, which, maybe it deserves to trade at a bit of a better premium than it is what it is right now. And the thing is, this company is not going to be hugely affected by COVID because it's not going to pay out a lot of the insurances, and as well as that, people still need insurances. You can't say, oh, I don't need a car insurance now because of COVID. You're still going to have to get car insurance, home insurance, so it's still going to do okay with what's going on out there in the world right now. And previously, when you look at what Money Supermarket did, it actually offered some revenue growth that was okay. We're not talking about a company that had, amazing growth. It's not a growth company, but it still grew revenue in the right way, and it also grew profit as well in the right way. Same again, not a massive growth company. It's only growing, profit at 4-5%, but still it's moving in the right direction. And on the forecast side as well, it looks like going forward, little slump on COVID, but it will get back to growing revenue and earnings as well, which is really positive. So it looks like a company that was doing previously okay before COVID will do good after COVID. And I think more and more people, especially the younger generation, definitely all kind of go on a lot of these compare sites for the insurances. On the financial side, pretty healthy. There's 2.5% debt to equity, which that debt was only recently taken on. And yeah, the debt is 5 million. But like I said, 2.5% is pretty low. And also it's got cash on there of 12 million compared to that debt. So yeah, 4 times nearly cash to debt, which is pretty good. It does pay a dividend of 4.1%, which I believe is still getting paid out. Double check that before if you are going to invest into it, because sometimes Simple Wall Street likes to be a little bit slow on updating everything. But it's a company that has paid a dividend for quite a long time. Like I say, you get a little bit of growth here, a little bit of a dividend yield. The dividend payout is about 74%, which is not too bad. Could be a little bit lower, but still okay. And on the inside front, not massive news. There was some shares bought by the chairman in February pre-COVID, but there were no one buying in the COVID dip, which would be a little bit more of a positive, but still some really good things going on with this company. So next up is Tesco, a supermarket, which we've never actually... Oh yeah, we did feature Marks and Spencer's once, so I'm lying there. It's actually the second supermarket we've actually had on the channel, or the second UK supermarket that we've actually featured on the channel. And this company, Tesco, was a company that was actually struggling quite a bit, but had a bit of management change, now doing okay. And obviously, it's a play that will do well if COVID carries on. People still need to go to the supermarket, go get the toilet roll. Even if there's a second wave, we might have another toilet roll shortages. And Tesco will benefit from that if there's a demand for them toilet rolls again. It's a stock that's pretty much traded flat, really. There's not massive share price gain. It has dropped a little bit since COVID, but not huge. But once again, it's not going to see much effect from COVID, so there shouldn't be much of a share price drop in this one. P ratio, a little bit high on 22, but kind of fair for the industry, a little bit higher than the market. Revenue-wise, it's a company that's pretty much had flat earnings growth. Revenue, once again, same, pretty flat. So you know, we're not talking about a growth company here. On the balance sheet, the company's done really well to get the debt to equity in a better place. So we now talk about 50% debt to equity, debt of 7.5 billion. When we look at the cash as well, 3.1 billion. So not too bad for a supermarket. Quite a lot of cash there, a bit of a safety net, and same again. Debt 7.5 billion. I mean, the company's done really well to change that balance sheet around, because obviously you look at, you know, 2015 to 2017, it was a pretty ugly picture. And according to Simple Wall Street, it does pay a 4.2% dividend. So like I say, we haven't got much growth here, but a 4.2% dividend in a very safe COVID stock here might appeal to a few people. And you can see here on the dividend yield chart, that's where they hit the problems in 2015, and slowly they've started to turn it around again, and pays a nice little dividend yield. Like I say, just check that one out, because sometimes Simple Wall Street isn't correct on its dividend yields. And when we look at the insider front, quite a nice bit of buying as well. So we've had a member of the directors that bought a lot of shares, and the chairman of the board, which was John Allen, he also bought a lot of shares last month, which was £66,000 worth of shares. So no selling and buying, which is also a positive. And the last one is another dividend play. So we've had like kind of a bit of a solid growth and a bit of dividend, and Tesco, which is probably, you would definitely count that as a dividend stock. And then we're going to finish off with another dividend stock, which is British American Tobacco. And to be honest with you, if I didn't own Altria, I might be tempted to actually buy this one. So they sell cigarettes, and they also looking at, you know, the e-cig play. Obviously cigarette sales are kind of dropping, but they are moving in the right direction, you know, V6s and everything like that. So I think it's one of those that they'll kind of, you know, there's always going to be people that smoke, and as prices go up, I'm sure they'll kind of cover the, you know, dropping people that aren't smoking. So even though the industry is kind of dying off a little bit slowly, I don't think it'll ever die. I think there'll always be a market here. And on the share price front, it's kind of been on a bit of a decline since 2017. Back in 2017, it was about a £50 stock, and now it's down at about £27. P ratio is 9 compared to the industry. It's quite a fair P ratio, but compared to the market, you can see it's a pretty cheap stock, and obviously the share price is down quite a bit. When we take a look at the earnings and revenue front, it's a company that has done quite well to just slowly increase that revenue in the right direction. On the earnings front, once again, a company that's moving earnings slowly in the right direction as well. And debt to equity, not too bad at 72%. Cash, 5 billion, and debt at 49 billion. But this is kind of common with a lot of cigarette companies. They don't like to have a lot of cash there, they like to pay out in dividends. And also if they get fined, they don't have to pay out as much fines, because they say they haven't got much cash. And like I say, big dividend stock at 7.7%. Like I say, once again, just check that before you do invest into it, as well as reading the annual report. But you can see it's a company that has, you know, really increased the dividend over the last few years. And like I say, it's a nice healthy dividend as well, isn't it, at 7.7%. And it's quite a low payout rate at 74%. On the share front, there is, 2,000 shares, but on the inside, not a huge amount, but hey, it's better than anyone selling it. So guys, those are 3 cheap UK stocks for you guys to have a look at. Let me know if there's any stocks that you're looking at buying as well. Hope you enjoyed this, and I'll try to keep this series going forward. As always guys, smash that like button, subscribe if you're new around here, and I'll see you in the next video.